Hi dear traders, you're watching a recap of the Asian session on July 6 with me, Maria Stardup. The markets in the Asian Pacific region traded lower. Investors gave in to the global pessimism, so the markets closed in the red. The US Federal Reserve confirmed its hawkish rhetoric and set the tone for market sentiment. Investors are unnerved because a trade war between the US and China has been brewing up. Today, Treasury Secretary Janet Yellen is beginning her visit to China. US Treasuries climbed to the highest level in the last 4 months during the Asian session. The US dollar asserted its strength against most rivals. The yen stood out among the rest and tightened its grip against the greenback. Traders are speculating about the likelihood of forex interventions. The Asian markets mainly lost ground on Thursday, responding to negative news from Wall Street. Asian traders were focused on the events in the US. The economic calendar for Asian economies is empty today. Australia's trade balance showed that a profit in May was higher than expected because exports surpassed imports. Stocks in Australia, Japan, South Korea and Hong Kong slipped in sync, whereas stocks in mainland China went up. So Chinese stocks recouped some losses of the previous session. The shares of fast-growing high-tech companies propelled the rally. Perhaps it happened due to easing geopolitical jitters, as US Treasury Secretary Janet Yellen is arriving today in Beijing for her 3-day visit. Referring to the minutes of the Fed's last policy meeting released yesterday, policymakers were divided in their viewpoints about trade. Fed hawks decided to take a wait-and-see approach. Currently, market participants foresee an 85% chance of a rate hike by 25 basis points at the meeting on July 26. Now investors are trying to puzzle out what moves the Fed will take after that. The question is still open. There is a 50-50 chance for another rate hike by November. Today, investors will get to know the ADP employment report. It prefaces the official non-farm payrolls that will be available on Friday. Investors will be riveted to the talks in Beijing. The visit of Janet Yellen coincides with the time when Beijing imposed restrictions on exports of some metals used in semiconductor production. The talks are going to be tough, and that will trigger high volatility in markets. Janet Yellen has been warned that restrictions on exports of certain gallium germanium compounds are a deliberate move and a pursuit of broader actions. China affirms that such actions are not aimed at a particular country. Still, the situation looks as though the US, supported by Japan and the Netherlands, has ratcheted up trade restrictions on chip technology with China. Markets are very sensitive to this situation. The US dollar has been picking up steam, benefiting from the Fed's hawkish rhetoric. The US dollar index has climbed to 103.5, not far away from a 3-month high. The Fed's minutes are cementing expectations of a rate hike this month. Besides, the US dollar owes its strength to the stability of the US economy. The greenback has lost 0.5% against rival currencies this year. However, its index has advanced by 1.3% over the last week for the simple reason. Investors are no more anticipating that the Federal Reserve will soften its policy and begin rate cuts. A recession now seems less probable in the US this year. The highlight of the week is certainly the government employment data for June. Robust hiring could give fresh impetus to the economy and reinforce the US dollar in the short term. Most market participants revised their forecast for the US dollar to bullish for the next 6 months. Meanwhile, short interest on the dollar fell after reaching a 2-year peak in May. Thus, the dollar has great upside potential in the near term. The economic situation in the US seems to be better than Europe and Asia, making a prolonged rate hiking cycle by the Fed more likely than by most other central banks. Expectations of the Fed policy tightening dragged the Japanese yen down against the dollar. Today, on the contrary, the yen gained value. In the Asian session, it advanced by nearly 0.7%, driven by the expected intervention. Japanese officials regularly express concerns about yen weakness. After all, the currency is approaching the 145 mark. Notably, its slide to that level prompted the government to intervene in the currency market last autumn. On Friday, the Asian currency briefly passed 145 per dollar. However, as practice shows, verbal intervention only works for a couple of weeks without actual currency intervention. It's only a matter of time before the yen reaches the 145 level or higher amid rising US yields and the Bank of Japan's continued dovish stance. In addition, now the market has no doubts about the Fed's policy stance, which is as hawkish as it can get. The American dollar-yen pair is expected to test the support level of 144.05 and then rise above the level of 146.75. In a bear case scenario, the pair may dip and overcome the 143.25 mark. A breakout of the support level will pave the way for the area below 139.35. On Thursday, the Australian-American dollar pair spent the Asian session trading still at around 0.6660. Despite its feeble attempts to advance, the quote is expected to extend losses. The macroeconomic calendar is bereft of any important news releases from Australia. This means that the pair will most likely keep trading within their technical analysis and depending on the dynamics of its American counterpart. The US dollar is currently gaining ground. Moreover, the upcoming events are expected to fuel its rally. Against this background, the Aussie seems to have no choice but to go down. There is a likelihood that the Australian-American dollar pair may try to test the resistance level of 0.6685 but then drop to the level of 0.6515. Alternatively, if the quote breaks through the area of 0.6725, it will have every chance of rising above 0.6975. Like the Aussie, the New Zealand dollars continues to trade under pressure from the dollar's rally amid expectations of a possible Fed rate hike later this month. At the same time, the average inflation rate in New Zealand, which remains well above the central bank's target, could add to uncertainty about the further dynamics of the New Zealand dollar. If the Reserve Bank of New Zealand pauses interest rate hikes at its next meeting, the Kiwi may come under stronger pressure. In addition, economic data from China, New Zealand's largest trading partner, shows that services sector activity is shrinking, which may also affect the Kiwi. Traders are likely to keep a close eye on the Reserve Bank of New Zealand's meeting to spot any clues about future monetary policy and therefore future movements of the New Zealand dollar. The New Zealand-American dollar pair is expected to face resistance in the 0.6235 area. If the quote fails to overcome it, it will probably plunge below the 0.5955 mark. This scenario suggests a deep decline and depends on whether the pair breaks through the resistance level. As an alternative, the quote may go up and break through the level of 0.6295. In this case, a strong buy signal will be generated, thus pushing the pair above 0.6465 mark. Do not miss our video reviews on the InstaForex TV channel and keep up to date with the latest market news. We work to make your trading successful. Feedback is welcome. See you soon.